Hello and welcome back. Up till now in financial accounting and reporting, we've been looking at commercial entities whose motive was to maximize their profits, maximize their net income, maximize their shareholders' wealth. Now in this section, we'll talk about entities who are not so selfish, not so mean. Their purpose of existence is to provide service to the society, not profits. Hence, those organizations are called not-for-profit organizations or NPOs. Now, we can divide those NPOs into four groups. Number one, we could look at educational institutions like schools, colleges, universities. Number two, we could look at healthcare organizations like hospitals, nursing homes. Number three, we could look at voluntary health and welfare organizations like United Way, Red Cross, Greenpeace, Salvation Army. And then number four, we could have all other kinds of not-for-profit organizations like fraternities, labor unions, cemeteries, museums, libraries, performing art organizations. We could also look at professional organizations like our very own AICPA. Now, even though these are not-for-profit organizations, they do have a set of users who are interested in looking at their financial statements. Now, their users include their donors, their members, their creditors, and others who provide resources to these organizations. Let's say they're receiving government grants. The government wants to look at what's happening with the money. Now, the users basically want to assess, number one, the service that the not-for-profit organization is providing. Number two, the ability of the organization to continue to provide those services. And number three, the method used by the organization's management to discharge their stewardship responsibility. Now, for not-for-profit organizations, we are looking at these financial statements. So we'll start with the statement of financial position. So this is like the balance sheet of the not-for-profit organization. So we could say this is the balance sheet. Now, balance sheet for commercial entities, we had assets equals liabilities plus equity. Now, here again, we're going to have assets of the not-for-profit organization, which is equal to liabilities plus not equity. We're looking at net assets here. So you have assets plus is equal to liabilities plus net assets. Now, net assets are divided into three categories. You could have unrestricted net assets, temporarily restricted net assets, and you could have permanently restricted net assets. Now, the restrictions that I'm talking about here is not internal. These are donor-imposed external restrictions. Let's say the not-for-profit organization has received some contributions from one of its donors, and the donor tells them, do anything you want with that money. That is increasing the asset. Cash is coming in, and that goes into unrestricted net assets. But let's say the donor is giving them some cash and telling them, use this cash only for cancer research. Now, they can't do anything that they want with that money. So yes, their cash is increasing, but the money that's coming in, that goes into temporarily restricted net assets because they have to use it only for cancer research. Or let's say the donor tells them, take this money now, don't use it for 2 years, use it only after 2 years. Again, cash is increasing, but this is temporarily restricted. So this temporary restriction can be due to purpose, use, or time. Let's say they've received some endowments where the donor says, never touch the principal. You can only use the interest out of the investment that you make out of this money. So the cash is increasing. They might have invested it. So investments increased. But this is a permanently restricted net asset. Now let us say the donor told them, out of this permanently restricted endowment, whatever interest you're getting, use it only for cancer research. So the endowment, that's permanently restricted. The interest that they're getting from the endowment, increasing their cash, that's temporarily restricted. But if the donor said, do anything you want with the interest, then the endowment is permanently restricted, but the interest is unrestricted. So guys, we'll look at it again and again, but for now, understand the format of the balance sheet. So on one side you got the assets, the other side you got liabilities and net assets, not equity here. You looked at the balance sheet, the statement of financial position. Let's now look at the income statement. Now the motive is not profits. We call it the statement of activities, where we're looking at how these net assets have changed during the year. And then we look at what were the beginning net assets and reconcile it with the ending net assets. So this statement is not only their income statement, but also sort of their retained earnings. I'm just putting these names so that you're able to identify, compare the not-for-profit organization financials with commercial entity financials. So instead of balance sheet, they got a statement of financial position. Instead of income statement and retained earnings, they got a statement of activities. Now, on the statement of activities, they're going to have a few columns. So they'll have one column for unrestricted, temporarily restricted, permanently restricted, and then total. So let's say when they're getting in revenues, as I told you, these revenues could be unrestricted, they could be temporarily restricted, they could be permanently restricted. Then they would have net assets released from restrictions. Permanently restricted, will they ever get released from restrictions? No. But temporarily restricted, they would get released from restrictions. Their restriction is as to the purpose, use, or time. So after a certain point in time, or when the purpose is fulfilled, use is fulfilled, then they're going to get released from restrictions. We'll talk about that. Then you'll have expenses. So all expenses and losses. So all this would give you the change in net assets of the NPO during the year. So what's happened during the year? They've gotten money, they've spent out money. Change in net assets. Then what you do is you look at the beginning net assets or net assets at the end of last year. And this gets you to ending net assets. So you have the ending unrestricted, temporarily restricted, permanently restricted, and total. So these numbers, ending net assets, these tie into the numbers that you have on the balance sheet. So guys, in commercial entity terms, you could say change in net assets, that's sort of like the net income. Beginning net assets, that's like the beginning retained earnings, ending retained earnings. These numbers compare, they tie into the balance sheet. Now let's understand the concept of unrestricted, temporarily restricted, and permanently restricted. So as I told you, they've received some contributions from the donors, and the donor tells them, do anything that you want with the money. So let's say they've received $100. That's unrestricted. Let us say they've received $1,000 or $1,100 from a donor who tells them, use this money only for cancer research. Now that becomes temporarily restricted revenue. Now let us say during the year they're able to spend $500 on cancer research. So the expense is $500. Now expenses are always unrestricted. Now wait a minute, the unrestricted revenue was only $100. That was do anything that you want with the money. This is the money that's spent on cancer research. This was temporarily restricted revenue. So now that you've fulfilled the restriction for this money that's come in to the extent of $500, you're going to release $500 from restriction. You're going to reduce $500 here and increase $500 here. So this moves from here to here. Let's say all the $1,100 was spent on cancer research, then you would have released all the $1,100 from here and they would have moved to here. So guys, I'm sure you're getting this. This is net asset released from restriction. Ideally what's happening is when you're spending this money out, it's not affecting your unrestricted net assets. It's only reducing the temporarily restricted net assets. Because the moment you spend the money, so when you've received the contribution, it's $1,100. The moment you spend it, it's an expense here and it's a release here. And it gets reduced from here, moves in here. So that's the net asset release from restriction, and then expenses you're going to have all unrestricted. Now once again, let's say you receive a permanently restricted contribution. You received $100,000 of endowment and you're not allowed to ever touch the principal. But the conditions are that when you invest this out and you get interest, you could do anything out with that. So let's say you invest it out for a year at, let's say, 8% and you get $8,000 of interest on this. If you can do anything with this interest, that $8,000 is going to come in here. If, let's say, you're allowed to use that interest only for cancer research, then that $8,000 comes in here. Only when you spend the money, that's when this releases from restriction comes in here. Now, the temporarily restricted net assets, you could have restriction as to the purpose or usage, as I've given you an example, cancer research, or it could be on the basis of time. So let's say you've received some temporarily restricted revenue and it said you can't touch this money for the next 3 years. So after 3 years, that's when you're going to release it from restriction. Or let's say you could have received temporarily restricted contributions and the condition you can use it only for buying equipment. So the moment you go out and buy equipment, that's when you release it from restriction. So you go out and buy equipment, you buy an asset and it gets released from restriction. So guys, that's how you classify all your revenues as unrestricted, temporarily restricted, permanently restricted. Expenses you have unrestricted. So that gives you your change in net assets during the year. Then you look at what were the beginning net assets or net assets at the end of last year. And that gives you your ending net assets at the end of this year. These numbers that you have here, they tie into your balance sheet. So that was about your statement of activities. What are the activities that's going on from a commercial entity perspective, sort of like the income statement and statement of retained earnings. Now, let's look at the third statement, the statement of cash flows. Now, this again is similar to the cash flow statement that you have for commercial entities. And again, on this statement, you're going to divide your activities as operating, investing, and financing. So most of the stuff on a statement of activities, that's operating activities. When you're looking at buying investments, investing in others, or you're buying PP&E, that's investing activities. When you're raising debt, that's financing. Now, looking at this revenues, all the unrestricted revenues that you have, they are operating. All the permanently restricted revenues that you get, they are financing. Is unrestricted means you can do anything with that. You can run your operations with that operating activity. Permanently restricted, you can't touch the principal forever, financing. But when you have a temporarily restricted revenue, That could be operating or financing. So if that temporary restriction is for a long-term purpose, let's say to buy PP&E, to pay off bonds or notes payable, in that case, that's financing. But if the temporary restriction is for operational purpose, let's say cancer research, you can use it for salaries that you spend for cancer research, that is operating. So unrestricted revenue is operating, permanently restricted is financing. Temporarily restricted can be operating or financing depending on the type of restriction. Okay, so that was the statement of cash flows. Okay, then you have a fourth statement, statement of functional expenses. Now this is required only for voluntary health and welfare organizations. Now as you can understand, such organizations have a lot of activities. Now the users want to understand where have they spent the money. Have they spent the money on program A or program B or program C or G&A expenses or fundraising expenses? So that is basically your statement of functional expenses, which breaks down the expenses into function. So for voluntary health and welfare organizations like Red Cross, Greenpeace, United Way, Salvation Army, it's required as a primary financial statement. For other not-for-profit organizations, let's say educational institutions, healthcare organizations, labor unions, museums, this is not required as a primary financial statement, but you may present it in the notes to the financials. So generally we're looking at these three basic financials and the fourth one, statement of functional expenses, which is required only for voluntary health and welfare organizations. So basically put forth all the financial statements that you're going to prepare for NPOs, and let's look at all this on the book, and we'll come back and talk about contribution revenue, a major source of revenue for not-for-profit organizations.
Starting page 43, we are looking at accounting for highlight not-for-profit organizations or NFP. And towards the bottom of this page, we got the financial statements prepared by not-for-profits. So put a box around financial statements and highlight the statement of financial position, the balance sheet. Highlight statement of activities. Compare it to the income statement that we have for commercial entities. Highlight the statement of cash flows. And highlight notes to the financials. Besides, we've got a separate highlight statement of functional expenses, which report highlight expenses by nature, circle and highlight function. Now, alternatively, this statement of functional expenses could be reported on the face of underline the statement of activities or as a schedule in underline notes to the financial statements. Turn to page 44 and put a box around the statement of financial position. Right there, balance sheet. Now, on this statement of financial position that we have for not-for-profit organizations, we got right assets equals liabilities plus net assets. And to understand the classification for net assets, let's look at the box that we have towards the bottom of the page. So the traditional classification for net assets has been highlight UNA, that's unrestricted net assets, highlight TRNA, that's temporarily restricted net assets, and highlight PRNA, which is permanently restricted net assets. Now, FASB now has an updated classification for reporting purposes, where UNA is put an arrow and highlight net assets without donor restrictions. And they've combined TRNA and PRNA, put a bracket and highlight net assets with donor restrictions. However, to conceptually better understand financial accounting for not-for-profits, we will continue using the earlier classification. And for financial reporting, just remember the updated classification, where UNA is net assets without donor restrictions, and TRNA and PRNA, which is temporarily and permanently restricted net assets, are combined together into net assets with donor restrictions. Now, I want you to remember this. So put a star here. And let's scroll up on this page, do a little bit more of coloring. Put a box around net assets without donor restrictions. And as you now know, this is highlight unrestricted net assets or UNA. Put a box around net assets with donor restrictions. And as you know, this includes both temporarily and permanently restricted net assets. Highlight temporarily restricted net assets, which have donor imposed stipulations such that these restrictions either expire by passage of time or can be fulfilled by the not-for-profit's actions. Basically, these are temporary restrictions. So these restrictions may be highlighted based on time, which means that resources may be spendable only in some future period, or may be based on purpose or use, such that the resources may be spendable only on a specific program, activity, or asset acquisition. For example, it could be for cancer research or for acquisition of PP&E. Now, the net assets with donor restrictions may also be permanently restricted. So, highlight permanently restricted net assets, which are restricted for use by donor imposed stipulations, such that the not-for-profit cannot spend but only invest these resources. Such restrictions do not expire by passage of time and cannot be fulfilled by the actions of the not-for-profit. Basically, they are permanent. They're often referred to as highlight endowments. So I want you to put a bracket from temporarily restricted net assets to permanently restricted net assets. And right there, donor imposed restriction. So guys, once again, look at UNA or unrestricted net assets. That is net assets without donor restrictions. And then look at TRNA and PRNA. That's temporarily and permanently restricted net assets. We're going to club them together for reporting purposes. And we're going to call them net assets with donor restrictions. Move to page 45, where we've got a sample statement of financial position. The first section has all the assets. So the last line, total assets, highlight assets, which is equal to highlight liabilities and highlight net assets. Now, as we know, net assets, they're going to be reported as those highlight without donor restrictions and those highlight with donor restrictions. So without donor restrictions are the unrestricted net assets. With donor restrictions are those which are temporarily as well as permanently restricted net assets. Basically, TRNA plus PRNA. Now to page 46, where we're talking about disclosures or information about the liquidity or maturity of assets and liabilities, including restrictions and self-imposed limits on the use of particular items. Couple of bullets below, we've got an illustration. Look at note B. Put a box around net assets with donor restrictions, and right there, TRNA plus PRNA. Towards the bottom of this page, we got note D, which talks about put a box around net assets without donor restrictions. So the amount here is $92,600, of which it says that the not-for-profit entity's governing board has designated certain assets for the below purposes. So you've got quasi-endowment and liquidity reserve. Overall, $37,900, which are included within net assets without donor restrictions. And the reason for this is put a bracket and write these are internal restrictions, not donor imposed. So if there are certain net assets which have internal restrictions by the entity's governing board, not by donors, that's still net assets without donor restrictions, or we could call them unrestricted net assets. Right there, UNA. Now to page 47, where we've got put a box around statement of activities, which is comparable to the income statement that we have for-profit organizations. So on the statement of activities, you're going to have the top line highlight revenues or gains. So that's increase in UNA, TRNA or PRNA. So any increase in UNA or unrestricted net assets is reported as an increase in net assets without donor restrictions. Whereas any increase in TRNA or PRNA is reported as an increase in net assets with donor restrictions. Now, when we're talking about revenues and gains, underline investment returns are reported net of external and direct internal investment expenses. The next sub-bullet, highlight net assets released from restriction. So right there, that's TRNA to UNA. TRNA is classified within net assets with donor restrictions. And now we are talking about release from restriction. So now they become UNA, unrestricted net assets, or net assets without donor restrictions. And then we've got highlight expenses. And right there, UNA. Because all expenses are reported as a decrease in unrestricted net assets, or basically a decrease in net assets without donor restriction. Towards the bottom of this page, we've got a summary of increase and decrease in net assets which are reported on the statement of activities. So looking at the traditional classification of UNA, TRNA and PRNA. Now, revenues, they increase net assets across categories. Net assets released from restriction, we are talking about TRNA moving to UNA. So UNA highlight increases while TRNA decreases. Expenses, as we know, are reported as highlight decrease in UNA. Once again, when we present the statement of activities, we're going to present UNA as net assets without donor restrictions. And we present TRNA and PRNA as net assets with donor restrictions. And let's look at this on our next page. On page 48, we've got a sample statement of activities where top line, of course, is highlight revenues, gains, and other support. Underline revenue from contributions, underline investment return, which as we know are reported circle net. The next section is highlight net assets released from restrictions. And this could happen right due to lapse of time, use, or purpose. So we've got net assets being released from restrictions due to satisfaction of underlying program restrictions. Highlight minus $8,990 under the section on with donor restrictions, and also highlight the plus $8,990 under without donor restrictions. So as we know, this release is from TRNA to UNA, or basically the net assets with donor restrictions to net assets without donor restrictions. The next one, we've got net asset released from restrictions due to satisfaction of underlying equipment acquisition restrictions. And this one's $1,500 released. So highlight the negative $1,500 under with donor restrictions and the positive $1,500 under without donor restrictions. Again, TRNA to UNA. The next one is expiration of underlying time restrictions, and highlight the negative $1,250 and the positive $1,250. The next, we've got net assets released from restrictions due to appropriation from donor endowment and subsequent satisfaction of any related underlying donor restrictions. Highlight the negative $7,500, that's the TRNA, and the positive $7,500, that's the UNA. Next section, you've got highlight expenses and losses. So you've got expenses from program A, program B, program C, management and general, and then fundraising. Put a bracket there and write example of functional classification. And we're going to look at this on the next page. Now, all the expense amounts, as you see, are under the column of without donor restrictions, or the UNA column. Drop bracket there and write there expenses, that's equal to always unrestricted or always without donor restrictions. Now the total expenses, highlight $31,970. So the statement of activities has got revenues, net assets released from restrictions, and expenses. That gets us to highlight the change in net assets during the period. To that, we highlight the net assets at the beginning of the year, which gets us to highlight the net assets at the end of the year. And let's look at the dollar amounts here. So net assets at year end without donor restrictions highlight $92,600. With donor restrictions highlight 193,490. Total is highlight $286,090. And let us reconcile this with the statement of financial position on page F6-45. So turn back to page 45 where we had a statement of financial position. And let's look at the dollar numbers on the net asset section. Without donor restrictions, highlight $92,600. With donor restrictions, highlight 193,490. And the total net assets highlight 286,090. The same numbers that we had on the statement of activities. So basically, in short, the statement of activities reflects the change in net assets during the year. The change in net assets from last year to this year end. Now to page 50, where we've got put a box around statement of cash flows. Where cash flows are reported from highlight operating activities, highlight investing activities, and highlight financing activities. Now, under operating activities, you may use highlight direct or indirect method. Underline, if direct method is used, presenting a reconciliation to the indirect method is optional. Now note that this reconciliation is required for commercial entities but is optional for not-for-profit entities. Move down on the bottom of the page where again we have the statement of cash flows with operating activities, investing activities, and financing activities. Let's look at contribution revenue. Under operating activities, you're going to have highlight revenues without or with temporary donor restriction, not restricted for a long-term purpose. Whereas under financing activities, you're going to have highlight revenues with permanent donor restriction or highlight revenues with temporary restriction for a long-term purpose. Let's connect both of these and write contribution revenue. If it's UNA, that's revenue resulting in increase in unrestricted net assets, that's always operating cash flows. However, if the contribution revenue is an increase in TRNA, it could be either operating or financing cash flow. So if it's a short-term purpose, operating. If it's a long-term purpose restriction, then it's financing. However, if it's PRNA, that's a permanent donor restriction, then it is financing cash flow. Move to page 51, where we've got a sample statement of cash flows using, put a box around the option on direct method. So direct method is used for the cash flows from operating activities, where we have cash received from service recipients, cash received from underlying contributors, cash collected on promise to give, interest and dividends received, miscellaneous receipts, and then we've got cash paid to employees and retirees, cash paid to suppliers, interest paid, and grants paid. Gets us to highlight the net cash used by operating activities. And then we've got cash flow from investing activities. So that's purchase of equipment, proceeds on sale of equipment, insurance proceeds from fire loss on building, proceeds from sale of investments, and purchase of investments. Gets us to highlight net cash provided by investing activities. And then we've got the cash flows from financing activities, which includes the proceeds from underlying contributions received for, look at this, investment in perpetual endowment. So that's forever. Investment in term endowment, investment in land, buildings, and equipment, investments subject to annuity trust agreements. Yes, as we discussed, whenever there's contribution with a permanent donor restriction or contribution with a temporary restriction for a long-term purpose, all such contributions are cash flows from financing activities. And then you've got the other financing activities, which include interest and dividends restricted for reinvestment, payments of annuity trust obligation, payments on notes payable, and on long-term debt. Gets you to the total highlight net cash used by financing activities. Now, if you do a net cash by operating plus investing plus financing activities, you get highlight the net decrease in cash and cash equivalents. You then look at highlight the cash and cash equivalents at the beginning of the year to get to highlight cash and cash equivalents at the end of the year. Now, the number that you have on this page, 4575, the cash at the end of the year, right? Reconcile with the statement of financial position on page F6-45. Now let's quickly flip back to page 45. We've got the statement of financial position. Look at the line on cash and cash equivalents. End of last year, end of 2010, it was $4,960,000. End of this year, the current year, it is highlighted 4575. So the statement of cash flows talks about how the cash number has changed from last year to this year. Back on page 51, we've got highlight supplemental data regarding highlight non-cash investing and financing activities. So there's gifts of equipment or gifts of paid up life insurance where the cash surrender value is taken. So these are like non-cash investing and financing activities. Turn to page 52. We will look at the second option, put a box around the indirect method for operating activities. So here, the statement of cash flows, the cash flow from operating activities starts from highlight change in net assets. And we've got a number here, highlight $15,450. So that's a change in net assets during the period. And let's reconcile this with statement of activities on page F6-48. Now flip back to page 48. We've got a statement of activities. Look at the third last line here, the change in net assets. And the total number is highlight 15,450. And that's exactly the same number that we start our cash flows when presenting the operating activities using the indirect method. Now come back to page 52, where we're presenting the statement of cash flows by using the indirect method for operating activities. So we've started with a change in net assets, and then we've got a bunch of adjustments to reconcile the change in net assets to net cash used by operating activities. So draw a bracket around all those and write adjustments. Which get us to highlight the net cash used by operating activities, which is a negative 230. And right there, this is the same result as the direct method on page F6-51. So if you look at a previous page, you realize the net cash used by operating activities is again negative 230. So whether you use the direct method or the indirect method to present the cash flows from operating activities, the result, the net cash provided by or used by operating activities, that's going to remain the same. The next two sections, cash flow from investing activities and cash flow from financing activities, are exactly the same as what we have on the previous page where we've used the direct method. So draw a bracket around all of these, and right there, indirect method only for operating activities. There's no change for investing and financing activities. Now, towards the bottom of the page, we've got highlight supplemental data. Where we've got highlight non-cash investing and financing activities. Besides that, because we are presenting using the indirect method for operating activities, you also need to report or present, highlight the amount of interest paid.
Now we talked about contribution revenue, the donations that we get from the donors. They could be unrestricted or temporarily restricted or even permanently restricted. So let's look at it again, do the journal entries and understand the way it flows into the financial statements. So we're looking at contribution revenue. And we know this could be unrestricted or temporarily restricted or permanently restricted. So let's say if the donor has given us a sum of money, let's say $125, and he said, do anything you want with that. That becomes contribution revenue, unrestricted, goes into this column. So let's put the journal entry for that first. So cash is coming in and the credit is to contribution revenue, unrestricted column. So this is $125 coming in here. This cash goes onto the statement of financial position. Contribution revenue unrestricted comes to this column. and flows on to unrestricted net assets on the statement of financial position. So cash is here, the unrestricted contribution revenue flows on here to unrestricted net assets. Now, let's say the donor gives us another sum of money. He gives us $1,100 and this time he tells us, use this only for cancer research. Now we can't do anything we want with that. We got to use that sum only for cancer research. So that becomes temporarily restricted. So cash is still coming in, but the credit is to contribution revenue temporarily restricted. So let's say this time it's $1,100. So cash, that flows onto a statement of financial position, asset side. Contribution revenue temporarily restricted, that comes in here. And from here flows into temporarily restricted net assets on the statement of financial position. So guys, this is the asset side, this is liabilities plus net assets. Net assets, sort of think of it like equity for the not-for-profit organization. So this one, the temporarily restricted contribution revenue would flow into temporarily restricted net assets. Now, when we actually spend the money for cancer research, that means the restriction is no more, it's released. So with that, we'll have another journal entry. So we'll have net asset released, temporarily restricted, and net assets unrestricted. Now this is not an additional revenue, this is just a release from restriction. Now we had it as temporarily restricted net assets on a statement of financial position. Now it needs to move to unrestricted because the restriction is now released. Guys, net assets, I told you, it's like an equity account. So it has a credit balance. The moment you debit it, that means you're reducing it. So we are reducing temporarily restricted net assets. And we are increasing, crediting unrestricted net assets. On your statement of activities, you're going to show this release by reducing it from here and increasing it here. Now the release has happened because we've actually spent the money, so it's an expense. Expenses, I told you, are always unrestricted to cash. So let's say we've spent the entire $1,100. So that comes in here. So already shown this to you, see it again. So $1,100 which was temporarily restricted now got released from restriction because you've actually spent it. What if you'd actually spent $1,200? Then the expense here would have been $1,200. $1,100 which was from temporarily restricted, $100 from your unrestricted revenue. Now, this was an expense. You could have also, let's say, you've bought equipment for cancer research. In that case, your journal entry would have been PP&E to cash, the entire $1,100. So no expense then, but you bought equipment for this, for cancer research. So no expense here. The equipment, that's an asset on your statement of financial position. There's just a release of restriction. Let us say the restriction on this contribution revenue was that after 2 years, we could do whatever we want with that. So at the end of that time restriction, there would have been a release, whether you spend it or don't spend it. So guys, 3 steps here. Number 1, you're looking at cash coming in as contribution revenue flowing in here. Number 2, you have the release happening when the restriction is released. And number 3, you're looking at how the restriction got released. Did you spend the money, expense it out? Did you buy PP&E? Or was it due to a passage of time? Now, generally on your CP exam, they try to test you with this, where they say an expense happened So ideally what has happened is there's no change in your unrestricted net assets. It increased by 1100, decreased by 1100. Only your temporarily restricted net assets decreased by this expense. So they love testing it on a few multiple choice questions. Now let's look at the third category, permanently restricted net assets. So let's say we've received $100,000 from a donor who says this is a lot of money. Don't you touch the principal, don't touch the corpus. You can invest this money, whatever you get, you can do whatever you want with that interest. So guys, in that case, the cash that's coming, the $100,000, the big money, that's contribution revenue. Yes, it is. But that's permanently restricted. So that one goes into this column. Now, they're saying the interest that you're getting from this, do anything you want with that. So again, cash coming in later from this investment. So let's say income from investment. If they say do anything, let's say we received $5,000, can do anything with that, that becomes U&A. This $5,000 goes in here. If they say use the interest that you get from this investment only for cancer research, then this becomes TRNA. Instead of UNA, we'll have TRNA. Instead of going into this column, it'll go into this column. And then again, you would have to release it from restriction, spend it out. So guys, that's the concept of classifying contribution revenue as UNA, TRNA or PNA. Unrestricted, temporarily restricted or permanently restricted.
Turn to page 56, where we're looking at contributions without as well as with donor restrictions. Highlight without donor restrictions or UNA. On the journal entry, highlight the credit side. Contribution revenue reported as increase in unrestricted net assets. Next, highlight with donor restrictions, TRNA or PRNA. Highlight temporarily restricted contributions. And on the credit side, highlight contribution revenue, TRNA. Now, when the restriction for these temporarily restricted contributions is released, then we have highlight debit to net assets released TRNA and the credit is to net assets released UNA. The expense is recorded as highlight expenses UNA. Note that net assets without donor restriction increase due to the release of restriction but reduce as a result of the expense. Therefore, there is highlight no net effect on without donor restriction. Basically, the UNA, right? If the cash is spent on expenses. So that's about temporary restrictions. Next, we've got highlight permanently restricted contributions like endowments. On the journal entry, on the credit side, highlight contribution revenue, PRNA.
Now, not-for-profit organizations often receive pledges where people, they pledge, they promise to contribute, to donate. So that is recognized by the not-for-profit organization as revenue when the pledge is made, provided the pledge is unconditional. So let's look at contribution revenue and we're talking about pledges. So if the pledge is unconditional, it's contribution revenue as of today. If it's pledge for this year, that's unrestricted revenue. If it's pledged for the next year, that's temporarily restricted because there's a time restriction there. Remember we said temporarily restricted net assets, that could be purpose, use or time. So if it's unconditional pledge, that means you recognize revenue at the time the pledge is made because you're sure they've promised they're going to pay. So let's look at an example that you have on your book. So it says NPO's Independence Day pledge drive in 2010 netted promises totaling $50,000 with half the pledge due by end of 2010 and remainder due by 2011. Based on experience, NPO expects 10% of the pledges not to be honored. That means 10% of the people, they promise but they don't pay. Journal entry to be recorded when the pledges are received. So it's going to be pledge receivable. They haven't touched the cash yet, but people have promised. Now they're going to have contribution revenue. So pledge for this year, that's going to be unrestricted. Pledge for next year, that's going to be temporarily restricted, time restriction. And there's going to be an allowance for uncollectibles. So the pledge receivable, that's $50,000. 10% allowance, $5,000. Of the remaining, half they would be receiving this year, half next year. 20-5 this year, 20-5 next year. Whenever cash is coming in, cash would be debited, pledge receivable would be credited. So let's say they receive all the cash for this year, in this year, 22,500. The bad debts, the uncollectibles happen as they are expected and they again receive the remaining 22,500 next year. So next year, so in this year's statement of activities, they're going to have $22,500 here and $22,500 here. Next year, when they receive this $22,500, even this needs to come to unrestricted. So next year what they're going to do is they're going to pass the net asset release from restriction journal entry and it's going to reduce from 22,500 on the temporarily restricted column, increase it on the unrestricted column. So the journal entry for that is the same as this one. Let's do it here, there. So that would be net asset TRNA. This is released and this comes into unrestricted. So this 22,500 for next year. So this is in 2010, this is the journal entry. 2011, this would be the journal entry when this gets released from restriction. Now, this was a pledge for 2010 and 2011. Let's say we're looking at a multi-year pledge where the donor pledges to give a certain sum of money every year for the next 10 years. So that becomes like an annuity. Every year, money is going to come in. Now, right today, when the pledge is made, the current portion would be recognized as contribution revenue unrestricted because that's going to be coming in this year. The future portion that's going to be coming in later, that would be contribution revenue, but that would be temporarily restricted. Now, because it's multi-year, it's going to be coming in second year, third year, fourth year, 10th year, you're going to recognize this future revenue at present value today. You're going to do the present value of the annuity. Now, when you actually receive the entire amount, so when you have this at present value, you're going to receive the entire amount later. The difference between the actual amount and the present value, that is not recorded as interest income. That is again recorded as contribution revenue. So you could say, to the extent of the present value, you would recognize the contribution revenue today. The difference between the actual amount and the present value, you're going to recognize the contribution revenue in the future. So that's for multi-year pledges. Now, here I told you unconditional pledge. That means they've promised no matter what, they're going to pay. What if this pledge was conditional? Guys, on the accrual basis of accounting, we're going to recognize revenue, contribution revenue, only when it's earned. So look at the example on your book. So it says, Mr. Match pledges to contribute $500,000 to an NPO if matching funds can be raised by the NPO within 1 year. So guys, he'll give $500,000 if you can raise $500,000 from other sources. The $500,000 will not be recognized as a revenue until the possibility of raising the matching funds is reasonably certain. So if you can raise 500 from elsewhere, Mr. Match, he will match it, he'll give the $500,000. So that's earned only when you're reasonably sure that you're going to get the $500,000 from other sources. Okay, look at the next one. Mr. Life pledges to contribute $100,000 to an NPO upon his death. So he says, once I die, I'll give you $100,000. Considering Mr. Life's life expectancy, present value of the pledge is $70,000. So the journal entry is going to be pledge receivable and contribution revenue temporarily restricted, because that's a time-based restriction. We are sure Mr. Life, he's going to die one day, but it's just a matter of time. With the passage of time, the restriction is going to be released and we're actually going to get the cash. So for now, it's pledge receivable and contribution revenue, TRNA. Because it's a significantly large period of time, we're going to take the present value. In the future, when we receive the total amount, the excess would be recorded as additional contribution revenue. So for now, it's $70,000 contribution revenue. So let's look at it on the book, and then we'll look at a few other specialized support contributions. Let's say donated services, donated collection items, and we'll also look at donated materials.
On page 53, we're looking at the accounting for contribution revenue. So when you have cash contributions, recognize when cash is received. Non-cash contributions, they're recognized at fair market value when received. As we know, contributions could be without or with donor restrictions. Now, underline, if the property or gift in kind is resold at greater than fair value recognized earlier, the excess is recognized as additional contribution revenue. Next, we've got pledges. So if it is an unconditional pledge, recognize when the pledge is made by the donor. The next sub-bullet, conditional pledge, recognize when earned. So basically, they're recognized as revenues only when they become unconditional or conditions are substantially met. Turn to page 54. Highlight multi-year pledges, where current year is recognized without donor restriction, whereas the future years is recognized with donor restriction. Now, multi-year pledges are recorded at present value at the date the pledge is made. For future collections, difference between the previously recorded present value and the excess amount actually collected is recognized as contribution revenue, not interest income.
Now we'll talk about some special contributions that an NPO can receive. Let's start with donated services. So the NPO might have some volunteers who donate their services to the not-for-profit organization. So Looking at specialized support. First, we're talking about now the NPO is going to recognize contribution revenue out of this donated services if it's an essential service. By essential, we mean it adds value. Let's say it creates or enhances their PP&E and or inventory. So that's an essential service. So let us say the NPO, they've got a fence to their building and that fence is damaged. One of the volunteers who owns a construction company, he says he's going to repair that fence. So in that case, that's a donated service. That becomes contribution revenue to the NPO. But did cash come in? No. He sent his people, he got the fence repaired. So the NPO now does not have to incur that repair and maintenance expense. So that becomes the debit here. So that contribution revenue from the donor helped the NPO meet this repair and maintenance expense on that fence. This is an expense. Expense goes in UNA. Let's say the cost of repair was $750. So let's see what's happening on the statement of activities. So from this donated essential service, repair of the fence, they recognized an unrestricted revenue of $750. They had an expense, repair and maintenance of $750. Now the change in net assets, that's zero. But on statement of activities, that's one of the activities that happened with the NPO. So they had a donor ready to give them $750 worth of services. Let's get back. So now we've looked at creating or enhancing PP&E inventory. How about the donor provides some specialized skills? Let's say a doctor, a lawyer giving legal skills, or a CPA like you guys, accountant. So you could go to a NPO and tell them you're offering your accounting services for free. Now, if you didn't offer your services for free, they would have to get some other accountant who would be so much more greedy and charge them for the services. So now, this is contribution revenue for them. And the debit, that is to accounting expenses. So now it's increasing the revenue, increasing the expense. No change in net assets, but you're still recognizing this contribution from donated services. However, if donated services were non-essential, such that the NPO would not otherwise have bought those services if they were not coming in for free. Let's say we're looking at a hospital and they've got certain volunteers who are ready to come in and read books to the patients. Now, if they didn't get those volunteers, would the hospital have hired someone to read those books? No, they won't. So this is a non-essential service for which the NPO would otherwise have not compensated. So this is not recognized. Now, I recall I was teaching the same content once in a class, and one of the students said, "Can I take this Miles books to the hospital and start reading them out to the patients?" Like, I'm not too sure, but if it's an accountant lying there in bed, I'm sure this is going to wish him a speedier recovery than the storybooks. So guys, kidding. Back here, we're looking at whether it's an essential service or a non-essential service. If it's an essential service which the NPO would have otherwise paid for, that's a contribution when it's a donated service. If it's a non-essential service, not recognized on the books of the NPO. So that was about donated services. Now let's say the NPO receives some donated collection items, some paintings, some artifacts. Now, this is recognized as contribution revenue. Only if the NPO has the right to sell this if it needs to and use the proceeds for whatever it wants. So it's getting a painting, a collection item as a donation. If the NPO has a right to sell that painting and use the cash for its operations or for any purpose, that becomes revenue for the NPO. Allowed to sell and use proceeds. So in that case, this becomes asset debit and contribution revenue credit. But generally, when NPOs, let's say a museum, receives those collection items, they are not allowed to sell it. And even if they sell it, there's a requirement that the proceeds that they're getting from the sale should be invested in other collectibles. So guys, what I'm trying to say is, don't recognize if, number one, this collection item, this is going to be used for display or research purposes. Number two, the NPO, the museum, let's say, is only responsible for preserving it, protecting it. The NPO preserves or protects the collection item. It's pretty valuable. And number three, if the NPO decides to sell this collection item, the proceeds must be invested in other collection items. Cannot use the proceeds for running the operations of the NPO. So if sold, reinvest in other collectibles. Now guys, in this case, does it make any sense in recognizing the revenue? Think about it. You would have contribution revenue and you would have an asset which you can't liquidate. So in this case, the rule is don't recognize. And the rationale behind this is, we do not want the NPO to look super rich. So let's say if it's $1 million painting and you pass this journal entry, asset $1 million, contribution revenue $1 million, the NPO looks so wealthy. Now they want to be pretty down to earth. They want a lot of donations. So they don't want to look very rich. So we say, if it's these conditions, forget it, it's not revenue for you. And generally it's these conditions for collection items. Only if the NPO has the right to sell it and use the proceeds in whatever it wants, that becomes a contribution revenue. Or use the proceeds in not buying other collectibles. So that was about donated collection items. Let's talk about donated materials. So if the NPO is getting donated materials, gifts in kind, the journal entry is asset or the material debit and its contribution revenue credit. But if these donated materials are passed through such that the NPO, let's say they're connecting donated clothing. So they're getting donated clothing from their donors, from their members, and they're going to donate it out for a particular purpose to a particular locality. So that's a pass through. They're going to get and donate. So in that case, instead of recording it as an asset, record it as an expense. So it's expense debit and contribution revenue credit. Expense unrestricted, contribution revenue unrestricted. So this is pass through. They're going to take the donated clothing, donate it out.
Back on page 54, we're looking at highlight donated services, which are recorded at fair value only if it's an essential service requiring a professional. So the second sub bullet there, highlight services that the not-for-profit would normally have purchased or essential services, such that the donated services help the not-for-profit reduce its expense and should be recognized as contribution revenue. Highlight essential services are those which create or enhance a non-financial asset, for example, inventory, land, building, or highlight require specialized skills like a doctor, lawyer, or an accountant that would otherwise have been purchased by the not-for-profit. The example of the free repair of the damaged fence of a not-for-profit by one of its volunteers is recorded as underlined expense on the debit, so that's repair and maintenance expense, and underlined contribution revenue UNA on the credit side. Next, donated services by retired services is underlined expense on the debit, so that's nursing expenses, and underlined contribution revenue on the credit side. Move to page 55 and underline the cost of soliciting contributed services are considered fundraising expenses, irrespective of whether the services meet the recognition criteria. Irrespective of whether the services are essential or non-essential. On the next sub-bullet, highlight donated collection items. They are recorded at fair value, highlight only if the not-for-profit has a right to sell the items without any condition to reinvest the sale proceeds in other collectibles. Now, the donations of art, artifacts, or antiques may not be recorded if all of the following requirements are met. So draw a bracket there and write don't record if number 1, the items are held for display or research purposes only, not for investment purposes. Number 2, not-for-profit preserves and protects the items. And number 3, if sold, the not-for-profit must reinvest the sale proceeds in other collectibles. So if all these 3 criteria are met, do not record these donated collection items. The next sub-bullet, highlight donated materials which are recorded at fair value. Where on the debit side, you have underlined asset and the credit is to underline contribution revenue. However, if the donated materials are highlighted passed through to an ultimate beneficiary, then the debit is to underline expense and the credit is to underline contribution revenue. And this is recorded only if the amount is substantial.
So we are looking at contribution revenue, donations received by the not-for-profit organization. So they could receive it in cash, they could have pledges, so that's a receivable. If it's property coming in, then they recognize it at fair market value on the date of the receipt of the donation. Now, they could get donated services. That's revenue only if it's an essential service. They could get donated collection items, paintings. Now, that would be revenue only if they're allowed to sell that painting and use the proceeds from the sale for other than buying other collectibles or paintings. But generally, it's not recognized because they're not allowed to do that. If it's donated materials coming in, something like donated clothing, that's a contribution revenue. But if it's just passed through, they're taking the clothing, would donate it immediately, it's an expense and revenue at the same time. So guys, we looked at expense and revenue at the same time here. So that's a similar concept. So it just shows that the NPO had a lot of activity happening during the year. Doesn't really lead to an increase in net assets. Now, let's look at contribution versus some other transactions. Let's look at agency transactions and exchange transactions. So in an agency transaction, the NPO acts as an agent, as a trustee, where it collects, let's say, cash for others. Now, if the NPO has variance power over the cash it's collected for others, and it's collected that cash for a financially related beneficiary, that's contribution revenue. So, if NPO has variance power, it decides what to do with that cash, and it's for a financially related beneficiary, then it's cash coming in and contribution revenue. But if these conditions are not present, so let's look at an example on the book. So it says, Shelter Society received $500 from Warren to refurbish Sachs' house, which was destroyed by fire. So Sachs' house was destroyed. Warren gave the money to Shelter Society. Note that the society is simply an agent or trustee without any variance power and no financial interest in Sachs. So no variance power, no financial relation. In that case, cash is coming into the NPO. So cash is debit, but the credit is not contribution revenue, it's a liability. They're getting in cash for the beneficiary, which is not related, and they got no variance power to redirect the money. Let's look at exchange transactions. Exchange means buying and selling of goods and services. So let's say the NPO is selling musical show tickets worth $100 for $250. Let's say tickets worth $100. They're selling this for $250. In that case, what we would say is this $100, this is exchange revenue. This is not a donation. The difference here, $250 minus $100, $150, this one is contribution revenue donation. So guys, that's contribution revenue versus other transactions versus an exchange transaction. Now, often what happens is NPOs, they receive contributions, donations, and they give out premiums, let's say a coffee mug, a calendar. Now, the cost of those premiums, which are generally given to potential donors as part of a fundraising appeal or to acknowledge a donation, are not treated as exchange transactions. So the revenue that's coming in, that's all contribution revenue. The cost of those premiums, coffee mugs and calendars, that's treated as a cost of fundraising. So it's not an exchange revenue where you want to divide exchange revenue versus contribution revenue. All of it is contribution revenue. The cost of those premiums, that's a fundraising expense.
Get to page 57 and put a box around agency transactions. Now, if the not-for-profit acts as an agent and collects cash or other assets for other not-for-profits, the receipt needs to be recorded either as a contribution revenue or as a liability at fair market value. It's considered highlight revenue if any of the below conditions are met. So the first one, not-for-profit has variance power over the donation and can redirect the money. Or highlight beneficiary of the donation is financially related. There's an ongoing economic interest in the other not-for-profit's net assets. And of course, if the contribution is recorded as revenue, the credit would be to highlight contribution revenue. Now, if the receipt highlight does not meet either of the conditions stated above, record as liability. So on the credit side, you're going to have highlight refundable advance or a liability being recorded. Next, put a box around exchange transactions. These are reciprocal transfers wherein each party receives and gives up cash or assets of approximately equal value. Now, classify exchange transactions as highlight revenues and net assets without donor restrictions. That's UNA. Even if there are limitations placed by the other party on the use of the cash or assets received. Now, generally, highlight the excess amount received over and above the fair value of dues or goods transferred or given up is classified as a contribution.
Now let's talk about a few accounting considerations that you need to remember when you're doing financial accounting and reporting for not-for-profit organizations. Now we know we are using GAAP accrual accounting. We've talked in depth about contribution revenue recognition. Now, if you look at the statement of financial position under assets, you're going to have marketable securities here. So you could have investment in stocks, investment in bonds. Now you got to use fair value accounting for those marketable securities. And all your investment income, so if it's investment in stocks, you're going to have dividend income. Investment in bonds, you're going to have interest income. So all that investment income plus any realized as well as unrealized gains and losses, all of that go into the statement of activities. So there's no OCI, no accumulated OCI out here. Next, under assets, you'll also have fixed assets, follow GAAP rules. So if you've purchased fixed assets, record it at cost, depreciate it. If you've received contributions, donations of fixed assets, remember, you need to recognize them at fair market value as of the donation date. Now under GAAP, we know that we depreciate, let's say, building, equipment. We do not depreciate land. For NPOs, you also need to remember that you do not depreciate works of art and historical treasures. Now, NPO, they would also be receiving a lot of endowments. Now, if they have received an endowment such that they can never touch the principal or the corpus, that is a permanent endowment and it goes into permanently restricted net assets. If they receive an endowment such that they can use the principal, the corpus, after a certain amount of time, that becomes a temporarily restricted net assets, which is restricted as to time. Now, let's say they've received an endowment which is not restricted by the donor, but the internal governing board of the NPO, they decide to restrict it for a particular use. Now, that's not a donor stipulated restriction, that's an internal restriction. Now this is called a quasi endowment. It's not actually an endowment, it's a quasi endowment and it goes into unrestricted net assets. Guys, remember, the restriction, this is based on donor stipulations, restricted by external donors. Internal restrictions, it still is unrestricted, and this is very important on your CPA exams. Now, fund accounting. Now, often not-for-profit organizations may try to create funds within the organization. Now, that's to ensure budget compliance. Now, they can use fund accounting for internal reporting purposes, but for external reporting purposes, there's no fund accounting out here. Now, they have an option, not required, they have an option to disclose those fund accounting numbers on the notes to the financial statements. Now, when we get to FAR-7, we learn that fund accounting, that's mandatory for governmental organization. So, if it's a governmental not-for-profit organization, let's say a state university or a city hospital, fund accounting is mandatory for external reporting. So private not-for-profit organization, there's no fund accounting out here. But if it's a governmental not-for-profit organization, you would have fund accounting here. And we'll look at that when we get to FAR 7.
On page 58, we're looking at a few accounting considerations for not-for-profits. Highlight marketable securities. And on the statement of activities report, highlight investment income, that could be dividend or interest income, and realized as well as unrealized gains and losses. And these are reported, circle net of, highlight external and direct internal investment expenses. The next bullet, highlight fixed assets. And remember that highlight do not depreciate works of art and historical treasures. Next, highlight fund accounting. Now, highlight for private not-for-profits, do not use fund accounting for external reporting. Couple of lines below, underline may use fund accounting for internal purposes or reporting, and they're allowed to disclose fund accounting in the notes to financial statements. However, highlight for governmental not-for-profits, highlight required to use fund accounting for external reporting. Move to page 59, where we've got highlight endowment funds. Now, these are funds for which the principal amount cannot be spent by the not-for-profit. Now, they may be highlight a donor restricted endowment fund, which is created by a donor stipulation, and therefore they are net assets with donor restriction. Now, the donor restricted endowment fund may be, underline, a permanent endowment where the principal or corpus can never be spent, while the revenues or gains may be spent per donor's stipulations. Now, these permanent endowment, they are permanently restricted. So write PRNA. Underline term endowment, where the principal or corpus must be held for a specified term or until the occurrence of an event as per donor's stipulation. So these are temporarily restricted. So write TRNA. Now, there could also be highlight board designated endowment funds, underline quasi endowment, which are created by the not-for-profit's internal governing board and not the owner. So these are net assets without donor restrictions. So right there, UNA or unrestricted net assets. On the next sub-bullet, highlight underwater endowment fund. Now, this is a donor restricted endowment fund for which the fair value is less than the original gift amount or the amount that's required to be maintained by the donor. So underline fair value and rate is less than, underline original gift amount, right, leading to, underline deficiencies. Basically, the funds are going underwater.
So we've been talking about the financial statements that you're required to present for not-for-profit organizations. And we've also talked in detail about accounting considerations, requirements for these not-for-profit entities. Now, we're going to talk about all the different kinds of not-for-profit organizations and look at certain specific requirements, mainly presentation requirements that you have for each of those entities. So first we'll talk about educational institutions, colleges and universities. Now, what's the major source of revenue for these colleges and universities? So on their statement of activities, the major chunk of revenue, that's from tuition and fees from students. Now, GAAP requires that the tuition and fees that you have on the statement of activities, this should be reported at gross. So that means it's before any scholarships or tuition remissions that these colleges and universities have provided. So scholarships, that's provided to brilliant students. So, and often these are reduced tuition and fees. GAAP requires that on the statement of activities, they're going to have gross tuition and fees, less scholarship expense. Similarly, tuition remissions, so they are like waivers of tuition fees provided to employees of the educational institution or their families. Now the requirement again is to show the tuition and fees revenue at gross, and the tuition remission is again an expense, a reduction of this revenue. Now, but if the loss of revenue is due to cancelled classes, that's not revenue earned by the education institution. So that's not included in gross tuition and fees. So let me put it all here. So you have gross tuition and fees, and the focus is on this word gross. You could say this is net cash inflow, and you adjust for any cancelled classes plus any scholarships. So these are basically not tuition fees received, but these are discounts given to the scholars, those brilliant students. So what we would do is we would include that in gross tuition and fees and then show a scholarship expense. Same thing for tuition remissions, waivers that you give to your employees and the families of those employees. So let's look at an example in the book and we'll plug in the numbers. So it says, Don Bosco College received $75,000 in cash as tuition and fee revenue during 2011, of which $2,000 was refunded to the students on account of cancelled classes. So they received cash $75,000 and they refunded back $2,000 because the classes were cancelled. They didn't earn it. So this becomes $73,000 of net cash inflow that they had. So, okay. During the beginning of the year, the college had an assessed tuition and fees of $90,000. The variance of $15,000 was attributed to $8,000 scholarships. So this is cash that never came in, and $4,000 tuition remissions, again cash that never came in, and $3,000 to cancelled classes for which cash was not collected. So cancelled classes, that's not tuition and fees. Calculate the amount of tuition and fee revenue to be reported on the statement of activities. On the statement of activities, you have tuition and fee revenue at gross. So that's 73,000 plus 8,000 plus 4,000 gives us $85,000. So 81 and 4, 85. So that's the number which goes on to the statement of activities. And from that, you're going to have a scholarship expense, $8,000, tuition remission expense, $4,000.
On page 60, we're looking at colleges and universities who are required to report their student tuition and fees at gross amount. So let's make a note there, right? Tuition and term fees that's equal to net cash inflow, right? Adjusted for refunds for cancelled classes plus scholarships and plus any tuition remissions.
Now let's talk about voluntary health and welfare organizations. So these are organizations like Red Cross, United Way, Greenpeace, Salvation Army. Now these organizations have a lot of programs going on. So on this statement of activities, we want to see how much is the money spent, what are the expenses for each of the programs. And there would be certain expenses which are there for supporting services, like G&A, General and Administrative Services, like fundraising for these programs. So the expense here would be broken down by the functional classification. So you could have expenses for program A, program B, program C, and then you could have supporting services, which could include G&A and fundraising. So let's say they got a program on health, they got a program on education, they got a program on community services. So that's expenses for each of the programs. So you're going to have expenses for each of the programs and then support services, G&A, fundraising. So that's there on the statement of activities. You got the total numbers. Now I also told you that for voluntary health and welfare organizations, you are required to present a separate statement of functional expenses, where we look at both the functional and the natural classification of these expenses. Now for other not-for-profit organizations, this is not required, encouraged, yes, but what they could do is they could present this in the notes to the financials. But for voluntary health and welfare organizations, this is a primary financial statement. Now the way this works is, so let's say they have program expenses, they got program A, program B, program C, and they got support services, total of program expenses. So they have G&A and fundraising, gives you total of support services, and then a grand total of all expenses. So that's the functional classification on your statement of functional expenses. So this is the statement of functional expenses. And here we're looking at this functional classification. Now what we'll do is we'll also look at natural classification of these expenses. So let us say we're looking at salaries. So how much of employee salaries did they give for program A, for program B, for program C, and what's the total of all the program expenses with regard to salaries? And then we're looking at salaries for the admin staff, for fundraisers, total support services relating to salaries. And that this plus this gives you the total expense number for salaries. Then let's say you could have professional fees. Again, you're looking at what's the professional fees for program A, for program B, for program C, total program expenses relating to professional fees, and then support services professional fees gives you total professional fees on this line. Then let's say they are printing a lot of stuff. So all the printing expenses for program A, B, C, total. Printing for G&A, for fundraising. So let's say for fundraising, they're printing and mailing out pledge cards. So that goes under fundraising here. Then let's say we're looking at conference and convention that they're holding. So if it's a conference or convention specific to program A, that goes under here. If it's specific to program B here, program C here, total programs is this plus this plus this. Let's say if it's relating to fundraising, that comes in here. So it gives you total and gross total of all the conference convention expenses that the voluntary health and welfare organization had. Then you could look at certain awards and grants. So if they've given awards under program A, B, C, would come in here. Generally, you'll not have support services, so total. Let's say depreciation. So if they have certain PP&E, certain vehicles for program A, program B, program C comes in here. Their office block come in here. Fundraising PP&E, so that's here, and you have a grand total out here. Now what you'll do is, let's look at what's the expenses per program and what's the expenses for the support services. So this total would give you an expense for program A. This total would give you an expense for program B, for program C, and the total program expenses. You have total G&A, total fundraising expenses, total support services, this plus this, and this is grand total. Grand total would mean you're doing this plus this. So this gives you the total expenses by this not-for-profit organization. So I said this was functional classification of expenses across functions. This one is natural classification by nature. So on this statement of functional expenses, you're looking at both the functional classification and the natural classification of the expenses. And then when you have these total numbers for program A, this number flows into the statement of activities, program A. Program B total number flows into statement of activities, program B. Program C comes in here. Support services, G&A, that's your number. Fundraising, this is your number. So basically what we're doing is the expenses, the total numbers, they're there in the statement of activities. But we want more details, especially for voluntary health and welfare organizations, where we require that this statement be presented as a primary financial statement.
Back on page 60, we're now looking at voluntary health and welfare organizations. So these are not-for-profits that meet both of the following conditions. Number one, they derive their revenue primarily from highlight voluntary contributions from the general public, and they are involved with highlight health, welfare, or community services. Hence the name voluntary health and welfare organizations. Now get to page 49, where we're talking about disclosures, where not-for-profits are required to report, put the box around expenses by highlight nature, circle, and highlight function. Now this disclosure was earlier required for voluntary health and welfare organizations only, but this is now highlight required for all not-for-profits, where the not-for-profit organizations can report these in one of the below locations. So it could be on the face of underline the statement of activities. It could be as a schedule in underline notes to the financial statements, or it could also be a separate underline statement of functional expenses. Now let's look at an illustration that we have towards the bottom of the page. So you got a note F with a table that presents expenses by both nature as well as function. So look on the rows to the left. You've got salaries and benefits, all of them put together. Grants to other organizations, again, all grants put together. Supplies and travel. You've got services and professional fees, all put together. You've got office and occupancy. Depreciation, you've got interest. So draw a bracket and write there, natural classification. Now look at the columns. You got highlight program activities. So you got program A, program B, and program C. And then you've got highlight supporting activities, which include highlight management and general and highlight fundraising. draw a bracket around program and supporting activities and write the functional classification. So as you realize, all the expenses are reported by both the nature as well as their function. Look at the number on the bottom right hand side. Highlight $31,970. So that's the same total expense number that we have on the statement of activities, which we saw on the previous page. So guys, now let's compare functional expenses which we have for not-for-profits with that of commercial entities. Right there. Functional expenses for commercial entities. So for commercial entities, we separate it out, right? COGS, right, plus selling and plus G&A. So that's the functional classification for all the operating expenses that we saw for commercial entities on the income statement. Next, right, functional expenses for not-for-profits. And that's equal to, as we've seen just now, program A plus program B plus program C. So that's all the program activities. And then we got, right, plus support services, which includes G&A and fundraising. So once again, the functional classification for not-for-profits is program activities and supporting activities.
We've been talking about financial statement presentation for not-for-profit organizations. We know that they prepare a statement of financial position. That's the balance sheet. They prepare a statement of activities. They have a statement of cash flows. And then we talked about some special requirements for colleges and universities. We said that top line is gross tuition and fees. When we talked about voluntary health and welfare organization, and we said for such organizations, we are required to separately present a statement of functional expenses, this statement out here. For other not-for-profit organizations, this can be presented as a disclosure. But for voluntary health and welfare organizations, this is a separate financial statement required. Now we're going to talk about healthcare organizations. So guys, once again, for not-for-profit organizations, I said they're going to have a balance sheet. Now, for healthcare organizations, what we'll do is the statement of activities that you have out here, we're going to break the statement into two pieces. Number one, we're going to have a statement of operations. So how has the healthcare organization been operating during the year? So the statement of operations is going to focus on this area of your statement of activities. So this is the statement of operations, which is only the unrestricted column, as you can see. Then we'll have a second statement, which we'll call the statement of changes in net assets, where we'll have the details for temporarily restricted changes and permanently restricted changes. And we'll have beginning net assets gives us ending net assets. So instead of one statement of activities, we're talking about two statements here. Number one, statement of operations. That's only the unrestricted column. How have they been operating? We'll talk about a performance indicator that we're going to have on the statement of operations. Second statement, we are looking at the entire thing here with the beginning net assets, ending net assets. This we call the statement of changes in net assets. So let's go on the other side of my board and look at both these statements. So we're looking at healthcare organizations. And the first statement we're looking at is the statement of operations. And as I told you, what we are looking at here is only the unrestricted column. Unrestricted column only. Now, when we talked about colleges and universities, we started with the tuition and fees. So what's the major source of revenue for healthcare organizations? Patient service revenue. So they provide medical services to their patients. They provide rooms, lab services. So that's their major source of revenue. So that's the top line here. We're looking at patient service revenue. Now, we're going to report this at gross. That's at established rates. And here we have medical service, room, lab. Now, one thing that you need to remember here is we will not include any charity care. So, exclude any charity care. Guys, if the hospital is providing patient services as charity, they're not going to charge them. There's going to be no billings there. So it's not there in the patient service revenue. Everything else is there at gross, at established rates. Now from this, we're going to subtract certain contractual discounts. So let's say the hospital is providing some discounts to various groups, let's say insurance companies or their own employee discounts. So that is reduced from this contractual discounts. So this could be Medicare, employees, and this gets us to net patient service revenue. So this was gross patient service revenue where we excluded any charity care, and now we get to net patient service revenue. So this is the amount of revenue that's actually coming to the hospital after the discounts. Now, apart from patient service revenue, the hospital might also have some premium revenue from capitation agreements. Now, these capitation agreements are agreements that generally healthcare organizations have with employers. So this is a contract where the healthcare organization says they're going to provide healthcare services to all the employees of the employer for a fixed dollar per employee. So this revenue is coming in for the healthcare organization whether or not the employees avail of the healthcare services. So that's like a premium revenue coming to the healthcare organization, and such agreements are called capitation agreements. Now, apart from this, the healthcare organization is going to have tons of other revenues. So we're going to look at other operating revenues. So, let me talk about this with a real life true example that I had. So what happened was I was working in New York, and one of my aunts in New Jersey, she was not too well. She was admitted into a hospital. So I drove down from New York to New Jersey to meet her, wish her a speedy recovery. Now, my aunt, she was into a hospital. So the hospital got patient service revenue from my aunt. Now, she was insured. So the insurance company had negotiated some discounts with the hospital. So the hospital actually got net patient service revenue from treating my aunt. Now, when I went to meet my aunt, I was driving down. So I parked my car onto the hospital parking lot. And they give me a parking slip. Guys, this is other operating revenue for the hospital, parking. So I walked out of my car with a parking slip, and I suddenly remembered, gosh, I forgot to get any gift for my aunt, and she's going to be so angry about it. So what I did is I quickly stepped into the hospital gift shop. and I bought 2 of these teddy bears. So this is one which is here with me. The second one, I'd given it to my aunt. Now this one, I'd bought it for my girlfriend who was living in LA then. I'm in a long distance relationship, New York to LA. Naturally didn't work out, and then when we broke up, she parceled all this, including the teddy bear, and sent it back to me. Well, that's a long story, and we'll talk about that later when we meet in person. But for now, we're looking at the second teddy bear which I gave to my aunt, and this one which I still have with me. So all this I bought from the hospital gift shop. So guys, that is other operating revenue for the hospital, gift shop revenue. Then as I was walking up the stairs to meet her, I suddenly noticed a florist there. So I also bought a bouquet of flowers. So that's another operating revenue for the hospital. Now I gave the bouquet and the other teddy bear to my aunt. She was very happy. She was very happy that I came down to meet her. But then she said, she's not so excited, not so happy with the food that's being served in the rooms there. So my aunt and me, both of us, we went out. We went to the hospital cafeteria to have our lunch. So that was cafeteria revenues for the hospital. Now, when I went to the cafeteria to have my lunch, I saw they have certain brochures and pamphlets put out. And one of them was talking about an educational program, a health awareness program that the hospital is conducting. Now I said, I'm a CPA, but I know nothing about first aid. So I decided to enroll into one of those programs. So that was the income from educational programs for the hospital, other operating revenues. Now, one of the brochures there also talked about medical transcription services that the hospital provided to other entities, other healthcare entities, other hospitals. So that was medical transcription revenues for the hospital. So guys, as you're getting it, we're looking at the major source of revenue, the patient service revenue. That's what we're starting with. And then we're talking about other sources of revenue that the hospital has. So we talked about premium revenue. And then we talked about tons of other revenue: parking, gift shop, cafeteria, education programs, medical transcription. Now, apart from this, the hospital also receives a lot of donations. So they receive donated supplies, donated medicines, donated equipments, blankets. All that again is other operating revenues. We're talking about donated supplies, medicines, equipments. Okay, so we're talking about the statement of operations, which I told you very clearly is the unrestricted column only. Now, because we are looking at the unrestricted column, whenever we have net assets being released from temporary restriction, they're going to flow into the unrestricted column. So out here, you're also going to have net assets released from restriction. Okay, let's go there. So when we looked at the unrestricted column, we had revenues, and then we had net assets released from restriction. So it got released from temporary restriction, came into unrestricted column. That's exactly what we're talking about here. So we're talking about the release that's happened from temporary restriction, because that's what has come into your unrestricted column, and that'll be there on your statement of operations that you're preparing for healthcare organization. The statement of operations out here, we're going to have net assets released from restriction. And what I would say is, here we're talking about the release which happens for operating expenses. Now we have seen whenever net assets get released from temporary restriction, they could be released for operating expenses or to buy PP&E. Now only those net assets which are released for operating expenses will come here, other operating revenues. Which are released to buy PP&E, they'll come in later, and we'll talk about that. So guys, we've looked at the patient service revenue, the net patient service revenue, premium revenue, other operating revenue. Now let's talk about expenses. Now the hospital is also going to have lots of expenses to provide these services. So we're looking at operating expenses. And naturally the doctors very highly paid, so the doctor's fees. You got to pay for drugs when they're treating their patients. Now, apart from that, they might also have some amount of bad debts. Think about it. Some people avail of the services from the hospital, but they got nothing in their pockets. That becomes a bad debt for the hospital. Now, the hospital naturally is going to have a lot of equipment, plant. So that's all depreciation expense here. Now, the hospital might also have certain amount of interest expense. We'll just put all that here. Part of operations of hospital instead of calling it non-operating. So the interest expense also comes in here. You could have a separate line item for bad debts, separate line item for depreciation, interest. Now the classification that's happening here, that could be natural, that's just fine. No need of doing it functional. You could do it a natural classification here. This functional expenses, we could do that in a disclosure because this is a healthcare organization. Now, after this, you get to the results from operations. So what are the healthcare organizations? What's the hospital's results from all its operations, from its patient services and other operations that it's carrying out simultaneously? Then we look at certain non-operating revenues for the healthcare organization. Now, when you're looking at non-operating revenues, let's say the hospital, the healthcare organization, they've received some donated services from volunteers. So that comes in here. They've received some gifts and grants, but those gifts and grants which are unrestricted. So let's say they've received unrestricted gifts and grants. Let's say they've had some unrestricted, once again, unrestricted investment income. So we're looking at unrestricted interest and dividends. Or they've had some unrestricted and realized gains and losses from investments. Now, we would also have certain unrealized gains and losses out here, but that's only if it's unrealized gains and losses from trading securities. So those securities, let's say the hospital has some extra cash. They went out, they bought some trading securities. Now they sold it. Even if they didn't sell it at year end, the unrealized gain and loss from trading securities, that comes in as non-operating revenues here. So realized, all of it, provided it's unrestricted, unrealized only if it's from trading securities. So all realized gains and losses, so unrestricted, all realized gains and losses, and we're looking at unrealized gains and losses from held for trading securities that the healthcare organization, the hospital has. Now, results from operations plus the non-operating revenues. This gives us the excess of revenue over expenses. Now guys, this line is an extremely important line for this healthcare entity. This is the line that we call the performance indicator. This indicates the performance of this healthcare organization. Very important. We'll call it performance indicator. Now, this line may not be same as the change in unrestricted net assets during the period. So even after this line for performance indicator, you might have a few other lines before you get to the change in UNA or the change in unrestricted net assets for the period. Now, these items could include unrealized gains and losses on other than trading securities. So guys, when you had an unrealized gains and losses from trading securities, that was a part of your performance indicator, non-operating here. If you had an unrealized gains and losses from other than trading securities, that comes in below. So it's still going into the change in unrestricted net assets, but it's just that it's not being included in this performance indicator. Now here we had net assets. So this, we're comparing this and this. Okay, now here you had net assets released from restriction, but this was for operating expenses only. Now we are looking at the entire unrestricted column. So whenever you have a release from restriction, it goes out from temporarily restricted column, comes into the unrestricted column. So if it's a release from restriction to buy PP&E, that's not part of your performance indicator, that comes in later. So here we'll also have another line for net asset released from restriction, and let's say to buy PP&E. So here, so this plus this gives you all the net assets that have been released from restriction. So this is for operating expenses, that's why it's other operating revenues. This is to buy PP&E. So it's a change in unrestricted net assets, but not a part of your performance indicator. So guys, the stress is, we are looking at what's the performance indicator, how has the hospital performed, and that comes in on the statement of operations. So this is an important line that we are looking at when we are looking at the healthcare entity. Plus we have certain miscellaneous items which is going to lead to the change in unrestricted net assets, because this is the unrestricted column. Now, okay, we have a lot of content out here. What we'll do is, we'll say, we are starting with net patient service revenue. Make sense? And then we have a host of other items. So the mnemonic for this is N for net patient service revenue, and then you have O for other operating items, then you have N for non-operating items, and then you have E, which is your performance indicator. So guys, when you are preparing the statement of operations for a healthcare entity, you got to make sure that you miss out none of these items. The first N stands for net patient service revenue. O stands for operating revenues and operating expenses. N stands for non-operating revenues. And your E, that's your excess of revenues over expenses, the very important performance indicator. So we've talked about the first statement, the statement of operations. So this is a piece of the statement of activity. So let's go and look at it again on our dashboard. So what I said is, this part is your statement of operations, where you just have the change in net assets. So we have the change in unrestricted net assets, because the statement of operations is only this piece of your statement of activities. Now for the healthcare entity, I said we're going to have a second statement, which we'll call the statement of changes in net assets. And let's go there and talk about that. So we've already looked at the statement of operations, the unrestricted column, and here we have the statement of changes in net assets. Now on this statement, we're going to have all the three. We're going to have unrestricted, temporarily restricted, and permanently restricted. Here it was just unrestricted. So we're going to start with U and A. What we'll do is, we'll transfer out numbers from here. So if you realize, here we had excess of revenues over expenses. So we would start here with this performance indicator. So we would have excess of revenues over expenses. And that would be the same dollar number as you have for the performance indicator out here. Then we'll also copy paste these other items here, and then we would get the change in unrestricted net assets. So you're going to have this performance indicator where we are looking at the excess of revenues over expenses, few other items like unrealized gains or losses from other than trading securities, net assets released from restriction but for buying PP&E, not for operating expenses, any extraordinary items. So guys, what we are saying is, we got two important line items here. Number one, we have this performance indicator. Number two, we have this change in unrestricted net assets. So we're going to have both these line items getting transferred here, plus the sandwich here. So this entire sandwich, okay, good term, gets transferred here into your statement of changes in net assets. So this finally gives you your change in UNA, or the change in unrestricted net assets. So all these items get to unrestricted net assets. So basically this was something we already had on the statement of operations. Last few lines we've taken it here. Now we are also going to have the changes in temporary and the permanently restricted items here. So you're going to have TRNA. So temporarily restricted items. So let's say they've received some contributions which are temporarily restricted. They can't touch it for a certain period of time, or they got to use that only for a particular purpose, for some operating expenses after a period of time, or to buy PP&E. That becomes contributions which are temporarily restricted. Now they might be making some investment income, interest, dividends, which is restricted, rather temporarily restricted. So here we had interest and dividend, which is unrestricted. Now we are looking at investment income, which is temporarily restricted. So after you have all this, you're going to have some net assets released from restriction. Release from restriction means it goes out from temporarily restricted to unrestricted. So guys, we've already seen that. So we saw some net assets being released from restriction out here, from the temporarily restricted column to the unrestricted column. We also have some release from restriction that's happening out here. So when you have the net asset released from restriction, it will go in here and here. So this plus this equals this. This gives you the change in temporarily restricted net assets during the period. Then we are looking at the permanently restricted net assets. So let's say use some contributions which were permanently restricted. That gives you the change in P&A. So this plus this is equal to change in unrestricted plus temporarily restricted plus permanently restricted. So this gives you the total change in net assets, increase or decrease in net assets during the period. Then we're going to have the beginning net assets, and that gives you the ending net assets. So this is the number that you're going to have on your balance sheet as ending net assets. So guys, basically what we've done out here is split off our statement of activities into two pieces. Statement of operations, where we are focusing on the unrestricted column only because we want to look at the performance indicator. You have certain line items even beyond the performance indicator which would lead to the change in unrestricted net assets during the period. So you have the change in unrestricted net assets out here, plus the change in temporarily restricted net assets, plus permanently restricted net assets. All these three, change in net assets plus beginning gives you ending net assets. So guys, that's all that you need to remember for healthcare organizations, and let's look at it on the book.
Let's get to page 61. We're looking at healthcare organizations who split their statement of activities into first one, put a box around statement of operations, and the next one towards the bottom of the page, put a box around statement of changes in net assets. Turn to page 62, where we've got put a box around statement of operations. And here we only have highlight the unrestricted column. The top line is highlight patient service revenue less any charity care, and then there's a deduction, highlight provision for contractual adjustments, which includes Medicare or employee discounts. This gets us to highlight net patient service revenues. On top of that, we've got right plus premium revenue from capitation agreements, plus highlight other operating revenues, gains and losses, less highlight operating expenses, which gets us to operating income. Then we've got highlight non-operating revenues, which gets us to highlight excess of revenues over expenses. Now, I want you to fill the bubbles with a mnemonic NONE, none, and the E of none is right, the performance indicator. So the excess of revenues over expenses on this statement of operations is the performance indicator for a healthcare organization. On top of this, we've got right plus unrealized gains and losses on other than trading securities, right, plus net assets released from restriction to buy PP&E, and this gets us to write change in UNA or change in unrestricted net assets or net assets without donor restrictions. Move to page 63. We'll be looking at a sample statement of put a box around operations. I want you to fill in the bubbles with a mnemonic NONE, none. The first N, highlight net patient service revenue. The O is highlight operating income. The second N, highlight non-operating income. And all these get us to the E of none, highlight excess of revenues over expenses. And right there, performance indicator. Turn to page 64, where we've got a sample statement of put a box around changes in net assets, which includes highlight change in net assets without donor restrictions, highlight change in net assets with donor restrictions, and that gets us to the overall highlight change in net assets. Now the starting point for the change in net assets without donor restrictions is highlight the excess of revenues over expenses. This was right, the performance indicator that we had on the statement of operations. Or write a mnemonic NONE and circle E because this was the E of none. So guys, as you can understand, the statement of activities is split into the statement of operations and statement of changes in net assets. This happens for healthcare organizations.